Welcome back to the Mortgage Motivation Podcast, and I'm your host, Gary Taylor. And today we're going to be talking about bank statement loans. So, someone that's self employed that's looking to purchase a home, this is yet another option for you. One of my favorite type of loans to use with someone that's self employed is the bank statement loan. All right. So, when you're looking to use your traditional product, like going conventional, all of your government loans, you're going to show your gross income. When you're self-employed, you don't have that as an option. We have to go with what they call your net operating income. So how much you truly making after you paid all of your bills, all your deductions been made. You're basically telling Uncle Sam that, okay, even though I made $100,000 with my business, I wrote off $30,000. So truly to Uncle Sam and to the lenders, you only made $78,000. So we have to use that as the income. So sometimes that may not work out in your favor. I've seen companies that made 400,000, but their true gross income, net income was maybe 50, 60,000 a year. And that's wasn't enough to provide them the funds that they needed in order to purchase that dream home. So bank statement loans is another option for you. So that's the critical part here, is that we do have a lot of options for every type of borrower that we come across. So with this, you must be self-employed. 1099, a great program for you. We will take your bank statements. So just like the title of the loan itself, we use your bank statement. So 12 months, 24 months, you can use personal and business tax returns, so which is really good. So if you can show that income being deposited into your account every single month, we're going to use 100% of those deposits, which is great. So you use 100% of that. But we have to add in an expense in there because obviously you're gonna have to pay some bills. There's third party bills that have to be paid for with your business. We definitely understand that. So most lenders will use the 50% expense ratio. So for an example, if you show that you made $20,000 with your business and in the average that we come up with, so say we take those 12 months, we do an average. If the average is like $20,000, then 50% of that would be 10 grand we can use, which is great though, because like I said, if you have a business that's bringing in a lot, but you actually have a lot of deductions, then you're gonna be left with what's left over. So that may not always work out in your favor. So instead of you spending the extra money for your taxes, just so you can purchase that home, you can keep your deductions in your taxes and utilize a program like this and still purchase the home that you want to buy. All right. So that could be used with personal, business tax returns, 12 to 24 months. But within that, some lenders, we all have to use is 2 or 3 months. So it just depends. But I just always like to put out there, it could be 12 months, it could be 24 months, but the lender themselves will let you know how much they need to see in order for you to qualify. You could use this loan program for your primary home, secondary home, or an investment property. So you do have more options. So you're not just locked into investment properties. Unlike the DSCR, it must be an investment property. With the bank statement loan, you could use with all three. So as long as it's a single family, primary, secondary home, and investment, you could definitely use this product for that. As it pertains to credit scores, I like to see a 660 and above. Now, there are some lenders that will lend less than that, but you're going to pay the price. You're definitely going to pay the price. So you're going to see a higher rate. And with these loan products, that's on the non-traditional side, you will pay more in rate because it's more of a risk, which makes sense. 660 is what I say should be like your bare minimum. But me, I like to tell my investors, like, look, let's see, can we get at least a 700 credit score? So that way you could be more aggressive when it comes to your rate itself. So 660 as a minimum, but I like to see 700 and above to get into the little bit higher tier, but it's going to be more beneficial to you with the rate itself. And one of the questions that I get all the time, what is the down payment for a bank statement loan? So it's not like a minimum down payment for a primary home that's like a FHA or conventional when you're putting down 3.5% or 3% or 5%. Since this is a higher risk loan, you will look to put at least 10% down on the lower end. But typically you're going to see 15, 20, 25% for the bank statement loans. But there are lenders that will allow you to go down as low as 10%. So it just depends on your strategy and what lender that we decide to use. For an example, if you're looking to use this as a primary residence, having positive cash flow doesn't matter with that, because you're living in that primary home. It's not an investment property. So you say, you know what, maybe I could just put down 10% and keep my money and use that for investments. That'll be fine. But if you're looking at this as an investment property, you may be looking at, okay, what will be my cash flow if I had my payment at $2,000 a month? How much can I charge the renter in rent every single month for me to make a decent amount on a monthly basis? So with that being said, you may be looking into putting down a larger down payment. So that's what I kind of comes in at too. Usually you can use that for that strategy. If you want to have more of cash flow, then you may want to put down a larger down payment. But to the lender, it looks better because now you're less of a risk because you put down a larger down payment. So your loan to value is going to be a lot lower. So something to kind of think of there. And also, when you put down a larger down payment, expect to see a difference in your rate as well. Lower down payment, slightly higher rates. More down payment, slightly lower rates. So take all that into consideration. One of the things that I want to discuss is the reserves that you want to have when you're looking to purchase a property. So primary, secondary, and investment property, you want to show reserves. The lender want to see that if you're not making any income in any particular month, that you have a backup plan. So if you're showing the lender that, hey, even though I'm buying this property, after I purchase this property, I still have 2 months, 3 months, I have 6 months, 12 months of reserves. And what reserves are is you basically have enough money to still make your payments. So your principal, interest, taxes, and insurance. So if your payment is at $2,000 a month and you have to show 2 months of reserves, that's $4,000 they want to see after you close on that transaction. Okay. And you just do the math from there. If you do 6 months, 12 months, you just multiply that principal interest payment by those months, and that would tell us how much money you would need. And it looks better to the lender because, once again, you're less of a risk because you have reserves, more reserves that you have. And you want to show the lender that you are definitely qualified for this particular type of a loan, and you're not as a large risk to them because you do have reserves set aside. And that could be your checking account, savings account. It could be a 401k. It could be stocks, anything like that. Anything that's liquid would count for reserves. The other thing would be is how much more are you paying out in a rate, because you're going with a non-traditional type of a product. So I'd say expect to pay 1% up to 2% more than whatever the market rate is that particular day. So for an example, if conventional loans are 6%, expect to pay 7%, 7.5%, 8%, even possibly 9%. It all depends on the scenario. So sometimes with a higher credit score, more of a larger down payment, you can see that rate kind of fluctuate. But just like any other program, you can buy those points down to get a lower rate. So you still have that as an option with these programs. So even though you may qualify at an 8.5%, you probably could buy that rate down to get it underneath the 8 or 7% to make the payment that you have a little bit more pleasing to you. So that's just another option for you, is being able to buy down that rate. But that's basically how the bank statement program works. There's a little bit more involved. It all depends on the lender itself. All the lenders have their own separate overlays. So basically what they're saying is, even though the standard is us showing 6 months of bank statements, we may want to see 8 months of bank statements, where every lender have their own overlays for that. So we'll just pick and choose which one would be better for you as a client. But if anytime you're talking to your lender, just ask, how many lenders did you look at? So if we put down a 20% down payment versus 25% down payment, how much will my rate change? Or if I need to increase my credit score, how much do I need to increase my credit score by for me to drop my rate down by 1/8 or a 0.5 point? So those would be some, just a few questions to ask. But once again, the key things here is the more you work on your credit, the more money you have set aside for your down payment, the more money you have for reserves, the better off this loan program can be for you. All right. One of my favorite loans for sure, because they're easier to do by far, and sometimes they close quicker because you don't have all the extra documentation that is associated with this loan. But that's the bank statement loan. I hope all of this makes sense for you. If you have any questions, feel free to reach out to me at any time. All right. See you. Peace.